Um, First of all, a very warm welcome to everyone who's joined us today for our interactive webinar, where over the next 90 minutes, we will give you a detailed insight into how you and your SMT can look to improve and indeed maximize both the value and attractiveness of your recruitment business in anticipation of its sale. By way of introduction, my name is Carl Swansbury, and I'm head of corporate finance at RG, which is a large independent advisory firm providing accounting, tax, and corporate finance advice to recruitment businesses on all aspects of growth, change, and transformation, with value accretion and extraction in mind. Over the last 17 years, I've advised on hundreds of acquisitions and disposals of recruitment businesses, including the sale of Encore to GI Group, the sale of Gap Personnel to BNext, the MBO of Energize Recruitment, as examples. And as a consequence, for sure, I have a huge amount of experience in helping owners of businesses improve value in anticipation of the ultimate sale of said business. I'm delighted today to be joined by a very experienced panel of three individuals who, like me, have spent years and years advising and indeed themselves creating incredibly valuable recruitment businesses. The first of our panel of three is Mike Ames, who himself has built and sold 2 recruitment businesses. The last recruitment business he sold being Crimson, which was sold to Harvey Nash, which I advised on the sale of. So Mike now spends all of his life helping other owners create saleable businesses. So I'm delighted to have Mike on the panel today. The second of our panelists is Ian Brent, who is a senior partner and M&A lawyer at national law firm Fladgate. Ian, like me, specializes in advising on the sale of recruitment businesses. So we are absolutely, for sure, very lucky to have Ian Brent on our panel this afternoon. And the third of our panelists is Sam Shield, who actually is a corporate finance professional working in my business alongside me, advising on all aspects of M&A, including, of course, advising on the sale of recruitment businesses. To complete the introductions today, I'm delighted to introduce you to Kirsty Ames, who will be our chat master for the session.
Thank you very much, Carl. Yes, I will. I'm just going to quickly cover off some housekeeping. First of all, please ask questions as we go through. It helps keep things interactive. We do promise to answer all questions. However, if we can't do it during the actual live bit itself, we will stay at the end until all questions are answered. Now, to do those questions anonymously, of course, we are using the chat function. So if you wiggle your mouse at the bottom, you'll see an option that says chat. If you click on that, it will open a little screen, and make sure the 2 says to hosts and panelists. And to get us started, to make sure everybody knows where it is, please let me know what year you started your business.
Thanks, Kirsty. And whilst we wait for responses to come into your question, can I maybe just ask each of the panelists to provide a brief insight into exactly what they intend to cover off during today's webinar? And perhaps I can maybe start with you, Sam.
Perfect, thanks, Carl. So the first thing that I'm going to run through is how a recruitment business is valued and what factors, play into that valuation. I'm then going to run through the exit process and what's actually involved when you come to sell your recruitment business. And I'm going to finally touch on the different exit options available to you and who or what you could actually sell your business to.
Thanks, Sam. And maybe, Ian, you can also give us an insight into what you plan to cover off this afternoon.
I'm also going to cover 3 topics. I'm going to talk about a negotiating trick that will ensure you leave nothing on the table. I'm going to give you a few tips about how to deal with the dreaded price chipping. And I'm going to talk briefly about why getting the right advisors will help you make the most money.
Thanks, Ian. And Mike, please, could you just give us an insight into what you plan to cover off during your section this afternoon?
Okay, all a bit mysterious, really, because I'm not going to tell you. But what I'm going to say is this: these are 3 lessons. These are 3 lessons that I wish I'd known before the 2 sales, because I learnt things during both sales. So I put together 3 things which I think will make a big difference to your attractiveness as a potential purchase, and also to max out that price. So that's me.
Thanks, Mike. Appreciate that. And as Kirsty said earlier, absolutely, today we do have genuinely a very experienced panel. So if you do have any questions, please throughout, do drop those into the chat box. They will be anonymous and every question will be answered. Kirsty, speaking of questions, it would be great to understand what responses you've received to your question of earlier, please.
We've had some really great range. We've had, I think the oldest one that popped up was about 2006, so some good time there. And the newest has started this year. So we've got a full range of years of people there. So it's going to be good.
Thanks, Kirsty. And irrespective of when you founded your business and irrespective of the size of your business, for sure, as you go about growing your business, you should do so with value accretion in mind. So we're delighted to have you all on this webinar this afternoon. So with no further ado, Sam, can I pass over to you, please?
Perfect. Thank you, Carl. So how is a recruitment business actually valued? What is your recruitment business worth? When we look to value a recruitment business, there's two key components that will feed into that valuation. One is your yearly profits, and then you also have a multiple applied to those profits by the buyer. So for illustrative purposes, if your business has profits of £1 million a year and a buyer applies a value of a multiple of 5 times to those, a kind of broad valuation for your business will be 5 million. Now, I'm sure we're all focused, increasing on increasing the profitability day to day, and therefore the value. But what about that kind of more mysterious but all important multiple that's applied to those profits? The multiple really kind of depends on the more qualitative aspects of the business, things that we like to think of as what are called value drivers. So the value drivers are levers that you can pull sometimes well in advance of a transaction to increase the value of your business by pushing up that all-important multiple. Now, there's absolutely loads to think about here. We'll touch on a few key ones today and also some that you can look to action immediately to increase the value of your recruitment business. Now, just to note, RGCF does have a strategic review tool which enables us to comprehensively review your business and identify both its strengths and its deficiencies in relation to these value drivers, so that any potential deficiencies could be addressed well ahead of a transaction. The strategic review tool is based on 9 value drivers, and just so we kind of all have a good idea of what we're talking about here, I'm just going to briefly flash them up on screen. So we've got them there, split kind of into strategic on the left, operational on the right. So we've got, kind of varied things in here: supply chain, operations, products, customers. We're going to touch on a few this afternoon, sorry, that you can just kind of think about and also potentially look to action today. So starting off first of all with shareholder objectives. And what we're talking about here is are the shares in the right hands of the right people at the right time? Because if we want to be tax efficient when we come to sell our business, and I'm sure we all do, having the shares in the right hands at the right time, and sometimes that can mean at least 2 years before an actual sale event, that could save us a 5-figure sum on the day of completion. We could save £100,000 simply by getting that organised well ahead of time, if we have the opportunity to get the shares in the hands of a partner or perhaps a spouse. We might also want to think about an enterprise management incentive, or EMI scheme, that you might have heard of, where we give members of the senior management team, key members of our business, the option over exercising rights to shares at the point of sale, so that they get some of the proceeds. What that does is it ensures that the senior management team are incentivized to grow the business with us in a way that increases its value when it comes to be sold. And it also displays to a buyer that we believe in our S&T and we want to reward them as part of the transaction. Indeed, like I said earlier, these are things that we can sort now. And if not, at the point of sale, ignoring that something like business asset disposal relief could cost you £100,000. Moving on from shareholder objectives to operations and systems, this is more so about the kind of little details that, when added up, can be really important. So we want to make sure that well ahead of a transaction, ideally 12 months before at least, we're producing really high quality management information so that our buyer has confidence in our business and its ability to be integrated into their larger company. We want to think about things like monthly management accounts. Are we preparing accurate, consistent numbers? Also, are we including the calculation of adjusted EBITDA in those numbers? Are we producing board packs for management meetings that show how we're aligned with our strategic goals and how we're tracking towards those goals over a period of time. Final kind of more financial point is, do we produce clear and defensible forecasts with clear assumptions that give the buyer confidence about the future performance of the business? Moving away from the more financial aspects, even the smallest details like the leases for the properties that we operate from, are they all properly documented? Do they have long term so the buyer doesn't need to worry about them? But are there break clauses in there so that if the buyer wished to, they could move away from those properties? Do we have employment contracts in for all employees with suitable notice periods? If we have an MD who's really key to our business, are they on a 3 or even a 6 month notice period? Are we dependent on any clients or consultants? I know this is something that Mike is going to expand a bit more on shortly. None of these aspects are deal breakers, but they will all go to value by feeding into that multiple aspect. Mike, I wonder if there's anything when you went through your sale process that you were surprised that the buyers were so interested in?
Yeah, very quickly. We had a product, an RPO product in those days that no one else had in the mid-90s. And the Americans were all over it, the buyers. They loved it because it was something different. And I think, well, they told me later that did significantly bump up the multiplier because we had that extra service that other people didn't have. So originality, I think, perhaps would be the answer to that question.
Thanks, Mike. And there's always those things that come up that you never think the buyer would be interested in. So, as I've said, RGCF does have a strategic review tool that enables us to kind of really focus in on those value drivers, potentially well ahead of a transaction to get under the bonnet of your business and kind of identify its strengths and potentially its deficiencies well ahead of a sale. We've just very quickly kind of touched on 2 of them there, but as you saw when I flashed them on the screen, there's 9, so there's so much more to explore. And please do get in touch if you'd like to explore that further. I'm now going to hand over to Ian, who's going to share some great tips on negotiations, which are a critical part of any company sale.
Thank you, Sam. So, look, the first thing I want to say is why what we're discussing today is so important for owners of recruitment businesses like you. And quite simply, it's a chance to make free money. So we've got sort of 68 recruitment company owners are logged in at the moment, and I'm sure many of you will be thinking about exiting in the next few years. And Sam has just explained how recruitment businesses are traditionally valued at a multiple of profits. So really, there are 2 ways of increasing what you get paid. You can either increase the profits, which is the hard way, or you can increase the multiple. And that is what this seminar is all about. And what I would say is not every point that Mike, Sam, and I will make is going to resonate with every one of you, but I guarantee that at least one nugget will. And if getting a tip that's going to work for your business means that you can tick that multiple up that you get from 4 to 5 to 6 to 7 to 8, even 9 times, then this will be the most profitable lunchtime you'll spend this year. So my first tip is this. I've spent the last 30 years negotiating every day to get the best deal for my clients. And this is the best tip that I can give you. Now, Sam is going to talk later on about the stages of the deal journey, and he will explain how once you've agreed the sale price with the buyer, you'll sign a document. Now, that document is sometimes called an LOI, a letter of intent, heads of terms, whatever it's called, it has the same effect from a negotiating perspective. There's a world of difference between your negotiating strength as a seller before heads are signed and after heads are signed. And here's the tip. Your negotiating strength is much, much stronger before heads are signed than after. Now, until you sign heads, if you've got good corporate finance advisors like Carl and Sam, they will have created competitive tension and potential buyers will be competing for the right to buy your business. If you have a good business, you'll therefore be in a strong negotiating position during that period before heads are signed. However, once heads are signed, the tables are almost always turned and the buyer will gain the upper hand. So why should this be? Well, here's the reason. Because at the same time as signing heads, potential buyers will ask for an exclusivity agreement. You may have heard of these, but typically you'll give the buyer around 3 months to complete the deal, and you'll agree not to talk to any other potential buyer during that period. Now, as recruiters, I'm sure you're all super savvy negotiators. So you will get how being the only show in town suddenly puts the bar in control. So the time for you as sellers to get the best deal is before heads are signed. Let me ask Sam, Carl. I mean, do you find this as well? You guys do a lot of the upfront negotiating. Do you find that this is the best time to get your clients, your sellers, to push hard?
Without doubt, Ian. I mean, without doubt. Ordinarily, we will be speaking to between 6 and 12 potential acquirers when advising on the sale of a business. And as a consequence, you know, at that point, when we are negotiating price, deal structure, how involved the shareholders will be in the business post completion of a transaction, we want to be able to have all of those pointed conversations and negotiations whilst we have multiple parties in play. Because naturally, once we go into exclusivity with our chosen purchaser, as you say, the negotiation tables turn. So for sure, the hard negotiation should always come upfront, pre-going into heads of term and exclusivity with our chosen buyer, Ian.
Yeah. You know, if I'd been paid £1 for every time a seller had said to me, come on in, let's just sign the heads and sort it out later. Or they get nervous and they go, Ian, we should just sign or the buyer will walk. If I'd been paid £1 for every time a seller had said one of those two things to me, I'd be long since retired. Now, will the buyer walk because the seller's holding out? My experience is that never, ever happens. Okay, I actually found the contrary is the case, and the buyer thinks I'm dealing with a savvy person here. So hold out, hold your nerve, and you will get the best result. So here's the message: negotiate really, really hard before heads are signed, because that is the time to get the best deal.
Couldn't agree more. Thanks, Ian. And at this point, Kirsty, can I pass over to you in case we have any questions which we should address at this point?
We do. We've had a couple of questions, and as I said, we don't have time to go through them all now, but we will answer them all at the end. But we've had a great one for Sam, which was, in the build up to a sale, should somebody aggressively hire or fire? Should they be lean? Should they be fat? What's more appealing to a buyer?
Yeah, and it's a good question, and I suppose it will ultimately depend on the specific buyer's motivations for buying. I suppose if we're confident that we can onboard those new hires and get them really profit generative before a sale, thanks to the multiplier effect on the profits, you know, any profits that they themselves generate will be multiplied up when it comes to the sale. So as long as that aligns with the buyer's objectives, I would say, you know, we should look to hire people in. I don't know if you would add anything to that, Carl.
I would agree with that sentiment. The only addition I would make, Sam, is that clearly if you are looking to sell the business 3 months from now, then you may naturally be inclined not to want to hire if those heads aren't going to be GP generative pre-close, because that could dilute profitability and in turn dilute the value of the business. That principle is fair, but actually what normally we would negotiate with a buyer is the need to add back the salaries paid to any unproductive heads if those heads have only recently been recruited in the 3 months prior to the sale of the business. So for sure, there is a way in which the earnings will not be suppressed by adding back the wages and salaries paid to unproductive heads. But I agree with Sam. Clearly, a buyer would acquire your business because of your ability to grow the business, which will only be possible on the back of headcount growth. And therefore, for sure, make the right hiring decisions, assuming you weren't looking to see the business sold, would be our advice. Kirsty, back to you in case we have any questions.
We do have quite a few questions, but in the interest of time, what I'm going to do is I'm going to save them for the end section, just to make sure, because there's some that I know might be answered in coming sections, and I think that's probably the best way. So I think it's probably time to move on to the next person.
Absolutely. Thanks, Kirsty. And I think the only thing that I do think we should maybe just address now is actually a point, Sam, you made earlier, which relates to taxation. So you said, Sam, that with good planning, you can save a significant amount when it comes to CGT or capital gains tax. Could you just explain, Sam, how the proceeds one receives on sale of shares will be taxed? And of course, therefore, what you need to do to make sure you drive down that CGT rate, please?
Yeah, no problem at all. So when you sell your business, the cash that you receive will be subject to, like Carl said, capital gains tax, not income tax. Current capital gains tax rates are 20%, and it's not stepped up like income tax, it's just a flat 20%. But as I alluded to earlier, there's something called business asset disposal relief, or BADR, which enables you to access a 10% tax rate for your first £1 million of gain. So therefore, you would only be taxed £100,000 versus £200,000. Those are the current tax rates. We do think that they'll go up, to be honest, to be more aligned with income tax rates, given there's a kind of significant disparity there, but we don't have a good view on when. In terms of transaction, other kind of probably quick things to mention. If you receive some shares in your buyer as opposed to consideration, you'll get what's called rollover relief on those shares. So you'll only be taxed on those when you sell those new shares that you received. And another thing I'll probably to quickly mention, deferred consideration, which can get a little bit complicated. There's two ways you can approach it. So you can either pay all tax on all your consideration on day one, which is helpful because you secure a tax rate, but it's also more challenging from a cash flow point of view. Or you can tax your income as it's received, but then you're leaving yourself more at risk to a change in tax rate. If some of the deferred consideration comes in as loan notes, it depends on whether they are what's called qualifying corporate bonds as to whether they might be exempt from CGT. But that's a kind of very quick run through, Carl, on how proceeds are taxed.
Thank you, Sam. So just to summarize for everyone's benefit, because I think that we're all super keen to reduce tax leakage where possible. So on sale of shares in a trading company, you will pay main rate capital gains tax of 20% on the gain. Okay, and that is standard. Unless you qualify for business asset disposal relief, as Sam said, which would mean that the first £1 million of proceeds you receive would be subject to a lower rate of CGT of 10%. All other proceeds beyond that million would still be subject to CGT at 20%. So clearly, if you have, say, as an example, a husband and wife owned business, both own 50% of the shares, both will be entitled to £1 million of business asset disposal relief and therefore paying CGT at 10%. What we often find, though, is there might be a company which is sole owned by the founder, and if he or she has a spouse, then he or she can transfer a proportion of his or her shares to spouse on a tax-free basis. But here's the tip: the person needs to have held the shares for at least 2 years prior to sale to benefit from business asset disposal relief. So if the sole shareholder, 6 months prior to sale, realizes that they should have transferred shares to spouse, that person will not get business asset disposal relief because they haven't held the shares for a minimum period of 24 months. So my advice is to anyone on this call, if you own 100% of the shares in your business, do ask yourself whether you should transfer shares to your husband and or wife. And make sure you do that 2 years prior to sale, because effectively you will save £100,000 on the first £1 million of proceeds, because of course that person will only pay CGT at 10% on the first million rather than 20%.
Yeah, that's fantastic. Carl, I think we are, for timings, I'm sorry to interrupt, we are going to have to move on just to keep things going.
Absolutely, Kirsty, indeed. And I think at this point, Mike, I think we're going to please ask you to share with everyone a brief insight into what they need to do to make sure they don't become a yo-yo company, using your phraseology, Mike.
Yeah. It's very popular in recruitment. Thank you for that. By the way, I paid 24% tax, so suck it up. That's what I say. Mind you, I paid 10%.
Everything is relative.
Yeah, I did. Yes, it's all relative. Anyway, la-di-da. So here's the thing. The first time around we sold, I was having a meeting with the equivalent of Carl. His name was Mark Asplin, our corporate finance guy, and we had lots and lots of meetings. So after the heads have been signed and you're in the process, there's lots of meetings, lots of paperwork, lots of data being gathered. He came to the office, I remember it vividly. He was saying about predictions and forecasts for the future and what we'd done in the past. And I said, well, I'd kept all our forecasts that we ever did. In those days, we were paper driven. So I'd got in a document, in a book, and it was all kind of yellowy paper. So you could see it was original stuff. He said, fantastic. how close is that to what you did? And I said, well, we never once dropped below the forecasts. We either were there or thereabouts, or we were ahead. He said, that's brilliant. He said, because what buyers are looking for is steady growth, predictable, I mean, quite big growth if they can get it, but predictable growth. And they also like it, the fact that you can predict and forecast and then nail those forecasts, because they're buying something that they want you to continue on with. And the chances are you'll be in an earn-out situation, as I was, and some of your money will come from what you deliver after the sale. So it's very important to be good at forecasting and delivering. Right now, if you don't do that, you become a yo-yo company, and recruitment is full of them. They're companies that grow and then they shrink, and then they grow and then they shrink, right? Buyers don't like that at all. It's not good. Quite frankly, as an owner, I don't suppose it's particularly good for you either. Now, it comes down to two different main reasons. I mean, there can be lots of reasons, the economy and what have you, but two big reasons. Use of 360 recruiters, which good luck with that one then. There is an alternative. And a bad management of your client estate. So usually too many eggs in too few baskets, or too few eggs in too many baskets, whatever. Too many big clients really, and not enough smaller ones. You lose a client, you lose some revenue. You lose a big 360, you lose some revenue. You grow, you shrink. Right now, the alternative is an active management of your client estate, which I'll be looking at a little later. So hang on for that one. And also using a layered rather than 360 approach to recruitment. Layered's a little different because it means that no one person is solely responsible for a revenue stream, whereas in 360 that's the case. So if 360 leaves, their revenue stream usually goes with them. In a layered model, you don't lose the revenue stream if someone goes, you lose a function, and they're relatively easy to replace. So it's incredibly important, when you look at how this works, it's incredibly important not to be overly dependent on people, individuals, because if you do that and someone goes, that's going to hurt. But by the same token, it's very important to manage your client estate as well, because if you do those two things, you're probably going to wipe out 90% of the things that you can control, leaving things like the economy or people flying aeroplanes into big buildings or whatever, things that we can't control, which is what it is. But if you want to control it, reduce the dependencies and also make sure that that client estate is managed properly. So let me very quickly just show you those key messages. I've got a key message for you. And also I've got two actions that you can take away. So key message is simply that, right? Avoid being a yo-yo company. Do whatever it takes to avoid that grow, shrink, because buyers don't like it and neither do you as an owner. And what you're looking for is secure, predictable and healthy growth that you can not only tell people, well, we're going to grow this much in the future. When they look back, they can see that that's exactly what you've done, right? So you predicted and then delivered. Now, here's a couple of things that you can do. First one is you can move away from 360s towards that layered model. Is it difficult? Not really, nowhere near as difficult as people think. And don't forget, when it comes to 360s, they're not all equal. Usually 20% of your 360 consultants deliver 50 or 60% of your revenue. So if one of those people leaves, you're losing a big chunk of revenue, which is not good. So a layered approach, a layered model will mitigate, or in some cases completely wipe that threat out. And also reduce key person dependencies. So if you've got bits of your business that depend upon a named individual for its success, particularly, by the way, you as the owner, then you need to reduce that dependency. And again, I'm going to touch upon that in my next message. So very clear actions there, and I would urge you to do those. Luckily, when I sold the first business and the second business, we could tick both of those boxes, but it was more by luck than judgment. It wasn't designed that way. So now I'm going to now hand over to Ian, who's going to talk to us about the very important subject of how to avoid price chipping, which, by the way, does happen. Over to you, Ian.
Thanks, Mike. So first, what is price chipping? You'll remember that I said that the deal never gets better once heads are signed. Well, here's a great example of what happens. Price chipping is a tactic used by experienced buyers to get a price reduction at a late stage in the deal. Now, I'm raising it because one of my roles as a lawyer is to maintain the value that the corporate financiers like Sam and Carl have achieved at head stage. So let me give you a quick explanation of why price chipping happens. Buyers will spend a lot of money on detailed financial and legal due diligence, and the accountants and lawyers who produce those reports are paid a lot of money and naturally will always look to justify their fees. In 30 odd years of doing this, I've never seen a due diligence report which says everything is fine. The advisors will always find something, and minor things can become quite major. So let me explain. In 2014, we acted on the sale of a public sector recruiter. It was actually #1 in that year's Hot 50, and it was being sold on a multiple of between 6 and 7. It had forecasts for growth. It had a great rent deal. Now, the growth forecasts meant that it would need new premises. It was showing how it would expand its personnel. And those new premises would cost an additional £125,000 a year. Now, you times that £125,000 by the multiple of 7 that the corporate finances had achieved, and you can see that that alone was a justification, or a so-called justification, for a price chip of almost £1 million. Mike, did you have any experience of this? Did people try and chip your price when you were selling your
100%.
businesses?
We were warned it would happen, and it did. Quite a way down, actually, and Mark Asprin was prepared for this, as Carl was, because it happened a little bit, I think, as I recall, in the Crimson deal. And I think this comes down to your last point, actually, Ian. I'm not going to take any more time up. This is all down to the strength of your corporate finance advisor, is all I will say on that, because I know you're going to talk about that a little later, aren't you? They dealt with it in both cases, and there was some negotiation, but it would have been a lot worse without them, 100%.
Thanks. So now you know why it happens and what it is. How do you avoid it? So here are a few ways of how you can avoid it. Okay, let me do the magic screen share. Okay, so the first, what I would say is, first way is just brace yourself for it. Okay, forewarned is forearmed, and I'm afraid that I don't know if you and Carl and Sam would echo this, but I see price chipping on around 75% of deals, especially when you have a private equity purchaser. And a typical amount that a buyer will try to chip, it's by around 10%. So it's a significant amount. And when the chip comes, it is a tense moment. Now, sellers who aren't braced for that will often react very badly and throw their toys out of the pram. And they will even say they won't do the deal. So if you know that it's going to happen, that's really going to help. And you can even play them at their own game and build a little buffer in if you do have a bottom line. And it will also allow you, weirdly, to retain a degree of trust for the buyer and accept that this is just part of the process. The second way is to try and prevent it. Now, how can you prevent it? 2 ways, I would say. The first, if you've got something that is going to come out of the woodwork, like that favorable rent deal that I mentioned, let the buyer know up front, because just remember, when you're in that strong negotiating position, that is your best time to deal with these sorts of things. So let the buyer know issues early. The second way is to just hold your nerve and realize that this is really just part of the game. However granular the deal they've gone into about the reasons for the reduction they're asking for, most buyers just want to know that they've reached your bottom line. So as long as you give them something off the price, that is all they want. And it will allow the FD to go back to his board and say he has got a reduction off your price. The final way is great. I've already sort of shown it to you on the screen there about letting the buyer finish the DD first. So let me just very quickly explain that, how that will help, because I think this is a real gem. It's simple, it's incredibly effective. So Sam is going to take you through the stages of a sale journey. So spoiler alert, the process is always going to involve due diligence and legal contracts. The due diligence can either be happening at the same time as the legal process, or the buyer does its due diligence first and then moves to the legals. So listen in. If you insist that the buyer finishes his due diligence before moving to the legals and ask the corporate finance to get them to reconfirm the original price still stands before progressing to the legals, the buyer's leverage to achieve a price chip is massively reduced, because that by that stage, only the buyer has spent a load of money on professional fees. And there's far less financial and emotional pressure on you as the seller than if you spent tens of thousands of pounds on lawyers like me and have been negotiating for months. So let the buyer finish his due diligence first. Carl, back to you.
Ian, I think that's a really good point. And I think the only thing I'd add to that is, of course, when negotiating and agreeing heads of term, what you can actually do is explain that if within 4 business weeks of heads being signed and exclusivity being granted, the buyer does not complete their financial, tax and legal DD and does not reconfirm that they are willing to proceed with the transaction based on the terms in the heads, then the seller can walk away and early terminate exclusivity, which of course, as you say, Ian, is another real great way of holding the buyer's feet to the fire and finding out early if the buyer intends to price chip. So a really great point, Ian, to have shared. So thank you for that. Kirsty, at this point, can I ask if there's any burning questions that have come in that we should try and address, please?
We do. I think we have a couple of quick fire questions, so I'm going to ask the panel to keep their answers fairly concise, just so we can get as many during the actual show. So somebody asked if there is a particular stage of the growth journey which you are more likely to get the highest multiple. And I'm guessing, Sam, you're probably the best person to answer that.
Yeah, interesting question. I suppose caveated with it depends, but I suppose a reasonable rule is that the larger scale of a business, the higher multiple applied to it. There is obviously a kind of ceiling on that where, you know, you don't become acquirable if you're huge, but assuming we don't get to that size, you want to really prove that your business is established. It's got you know, it functions and it, you know, makes a lot of money fundamentally, which is why people want to acquire you. So I suppose you want to be, you know, a reasonable scale. It'd be hard to put a number on that though.
Okay.
Let me just give a quick response to that.
Very quick response.
Okay, it's not legal. It's just a sort of a life response. You sort of reverse engineer it. Think how much you want to make. Don't be greedy. Don't think you've got to get that last pound, because you never know what happens around the corner. There's, you know, economic conditions can change. Your health can change. So don't wait to get that last pound.
Okay, thank you. And then we've got time for one more question probably, which is how many years of profit is the acquirer looking at? Because people are thinking COVID years obviously has affected their profit. And with this profit, is it before dividends are paid or after? So Carl, are you the best person to take that question?
Sure, more than happy to pick that up. Thanks, Kirsty. So in a growth business, we would be expecting a potential acquirer to value the business based on the forecast for the coming year, acknowledging that that will only be done if the forecast is demonstrated as being diligently prepared based on sound assumptions, and the business can show that historical forecasts have been achieved. That would be the first thing I would say. The second part of the question, Kirsty, was, is the profit number that is used for valuation purposes pre or post dividend? The answer is it's pre-dividend. So it would be the pre-tax profit, which is pre-dividend. However, if there is a business that has one shareholder and that business takes most of his or her remuneration in the form of dividend and not salary, then what you have to do is take your pre-tax profit and adjust it to allow for a salary that would be paid on a normalized basis if that person was employed and was not a shareholder. That gives you your maintainable earnings, and it's that number that would then be multiplied to arrive at our enterprise value or business value.
Okay, fantastic. So once again, if you've got any more questions, keep them coming. If we don't have time during the main webinar, we will stay at the end. Thank you very much, Carl.
Thank you so much, Kirsty. So I think Ian suggested earlier that we were planning on today's webinar to give you an insight into the actual sale journey. So how do you actually go about selling your recruitment business? And I think at this point, Sam, I'd be delighted if you could provide that insight, please.
Thanks, Carl. Yeah, no problem. So Ian's kind of touched on a few of the key points there. in terms of the kind of presentation he's just given, but I'm just going to give a brief overview in terms of, like Carl said, what's actually involved, when you look to sell a business. When we think of the sale process, we like to think of it as having three fairly distinct stages. The first stage is what we'll call preparation. This is all about value generation. So here we are preparing the business for sale. We are doing some thinking about the different buyers and what our potential buyer might look like. And we're also preparing the key documents that we'll use as part of the sale process to market the business and the opportunity to our potential buyers. That moves us on then to the second stage, which is what we call marketing. So this is where, when we between us have agreed on who our potential buyers are, we'll approach them with the opportunity anonymously. And then later in this marketing stage, you'll get to have some really interesting and exciting conversations with your potential buyers about what the acquisition might look like. The final and third stage is execution. This is about value protection and is a lot of what Ian's just talked about just now. So this is where we've agreed and signed heads with our preferred party. We've moved into an exclusivity arrangement, and we're starting to go through due diligence, financial, legal, and tax. And then we're also, Ian and his colleagues are negotiating and agreeing the fundamental legal documentation that sits behind the transaction. Given where I think probably most of us are on our kind of sale journey, we're going to focus more on the preparation stage today, what that involves, and even what can be done now, well ahead of a kind of a formal sale process to start preparing the business for sale. So the preparation stage, which might have even started when you joined this webinar this afternoon. I know it's something that Mike speaks a lot to on his LinkedIn, but the best time to start preparing your business for sale is when it was incorporated, and the second best time is today. So when we're thinking about that preparation stage, it's all about us as corporate finance advisors really getting under the bonnet of your business to understand and identify its strengths and maybe its deficiencies, so that the deficiencies can be addressed ahead of a sale, and so that its strengths are put front and center throughout the entire process, ultimately increasing the cash that you receive on sale. In the prep stage, there's two things that we invest a lot of time thinking about. One thing is your business, and the other thing is the buyers. So thinking about your business, even before we're formally engaged for the sale, well ahead of that sale, we can really dive into the detail of your business with the strategic review tool that I mentioned and the value drivers discussed earlier. What we can also do is prepare a valuation report, which is a discrete piece of work that values the business and gives you a precise and clear point-in-time valuation, so that you have an idea of the value potentially if you have to sell it now, or you can also use that to get an idea of a value, just before you kind of go through that sale process. Another thing as well, which we might look to do, is what's called vendor DD. So Ian talked a bit there about the different kinds of due diligence that you would be subject to in the execution phase. What we can potentially do is front load some of that time and effort. We can engage ourselves, a DD provider, to produce anything from some high level due diligence findings to a full diligence report that we would be able to give to buyers, our preferred party, meaning that they wouldn't have to go through that because they can rely on that report as part of the transaction. Everything I've kind of touched on there has different implications on timings or cost, but it's certainly worth thinking about because every business and every transaction is different. So I think that's the part in your business. If you're thinking about the potential buyers, we'll also use this time in the prep phase to work collaboratively with you to understand those key things, those USPs that are going to really attract the buyer to make them want to acquire your business. Once we understand the USPs and why a buyer would be interested, we'll agree what we would call buyer pools, which are different categories of buyer, kind of categorized by what value they would derive from acquiring your business. And then we'll use those to help frame our research, ultimately presenting to you a really long list of exciting and interesting names of businesses that we think might have an interest in acquiring your business. Our thoughts on who the buyers are and what the USPs are will also help frame the preparation of those documents I referred to earlier. So things that you might have heard of, like an information memorandum, an IM, or an executive summary, or even a business plan, which will set out the key aspects of the business and help inform buyers when they're looking to potentially acquire the business. One thing is probably just worthwhile touching on is, how long does this process take? Everything I've talked about there. Well, acknowledging, of course, that every business is different and therefore every process is different. it's probably a fair assumption to assume that from engagement of advisors to completion date, it's probably somewhere in the region of 6 months. Ian, I wonder if that tallies with your general experience?
Probably even longer than that. And in fact, we do a tracker of trends, and we are seeing that deals are taking longer to do. Not sure of the reason why, but certainly if it's 6 months from them coming to see you to getting the money on the table, then I think that will be good going.
That's what we're aiming for. I wonder if current recent world events are kind of giving buyers a slightly more cautious view in the diligence that they're looking into. But no, that's interesting. Thanks, Ian. So as I've touched on there, three kind of main parts of the sale process: preparation, marketing, and execution. And for all the reasons that we're all discussing today, the preparation stage is absolutely key. So if you do want to start thinking about that, even if you aren't thinking of selling until years from now, please do get in touch. I think Mike is now going to look at something that makes a big difference to company value, and that's how you win and keep your clients.
I am going to do that, thank you. But before I do that, let me just echo a couple of things that you said there, Sam and Ian. First of all, had we started preparing earlier, because we just took like that spur of the moment thing, let's do it then, we would have got £3 million more than we did for the business, right? And I can prove that. I'm not going to do it now, but I can go through, explain exactly where that money would have come from. And the other thing, it took us 11 months to sell the business for various reasons. So I'm not sure that's typical, but that's what happened to us. Okay, right. So here's the deal. I'm going to talk to you about something now, which is very important, whether you sell or whether you don't. If you do this, it will make you more saleable and more attractive. If you don't sell, it'll make you more profitable and it'll provide safer business growth. It's very important. Now, right, here's the thing. So when we went through the due diligence process, as both Sam and Ian have mentioned, the Americans who bought us were all over us asking questions, and most of those questions went to my business partner who was in charge of finances. One question that was very much aimed to me as the MD was all around my senior management team, and Carl mentioned this earlier on as well. Now I'm going to talk about SMTs in a minute, but first let me just drill down on what they were interested in. They wanted to know what they did. They wanted to know which clients they brought in. They wanted to understand which clients they looked after. They wanted to know how we won our clients. They wanted to know how we keep our clients. And they were very, very fastidious on that. It was incredibly important to them. And we spent a lot of time. Luckily, we did have a mechanism to win clients, which I'll talk about in a second, which worked. And I'll show you the results of that in just a moment. But they were very keen on it. Allied to that, we sold in November. And around about January time, we were up for an award. And I said to my boss in New York, I said, well, I come across a little early. We're up for a couple of prizes. We should win something. It'd be a great night. And it was a great night. It was a glittering night, in fact, spoilt only by the fact that we didn't win anything. Didn't come close, actually. But we had a good lash up and it was a nice time. Anyway, later in the bar, I said to my boss, I said, well, why did you come in at the pace that you did? We were going to sell to another company called Dimension Data, South African business. And these guys just came in 100 miles an hour, bowled everybody else up, significantly whacked up the asking price and said, let's get this done. And he said a lot of nice things, complimentary things. But one of the things he said was, which I was a little disappointed on really, was he said, well, you're obviously a process over people business. It's like, well, what do you mean? He said, well, you got great people, but you had really good processes and the support around that. We could see that you weren't really that dependent upon anybody really, apart from you. And in fact, when they looked into it, I wasn't really working on a full-time basis in the business at that point. My role was more leadership, really, I think, and inspirational, I guess. But the point I'm trying to make here is, and this is my key message, let me just share this with you, because this is a really important one. Whether you sell or whether you don't, right? My key message is have systems to build and cultivate your client estate. Systems. See, people are only part of the system. And when I say system, let me be very clear on what I mean by that. I mean processes, not as important as you might think, because people don't follow processes, but you've got to have them. Dashboards to tell you what the heck is going on in different parts of the business so you can manage properly. Tools, which are like really important. Tools are the key thing. And I don't mean software product tools, by the way, although they can be useful. And people, okay? You put those four things together into like an ecosystem. That's the thing that wins the clients. That's the thing that looks after the clients. And if someone leaves, well, you know, too bad, we'll replace them. I know it's not quite like that, you know, I get it, but that's the deal. Now, here's an interesting thing. Here's the growth in my first business. Have a guess when we installed our ecosystems. No prizes, 92, 93. So it took us 5 years to get to about 5 million and another 5 years to get to 40 million turnover, all because we had the right ecosystems in place to win high value clients and then to actually monopolize or become the apex supplier to those businesses. And that, as you can see, is exactly what happened. So I've got 2 actions for you again on this one. Very important. Sell or no sell. 100% do this, right? First thing is we have a scalability webinar. By the way, there's no trick to this. You don't have to do anything or register or give us your name or anything like that. You just have to tell me. I'll send you a link so you can watch that scalability webinar, which shows you how to build a layered fulfillment model, which we talked about earlier, and also shows you how to build a business which is safe and secure. It's an hour and 3/4, I think, similar to this kind of length, really, very detailed. And in the same place, you can download that free ebook, which exactly describes what we did. In case you don't like watching videos, you can just read about it. To get that, dead simple. If you're watching this live, all you need to do is put a 3 right now into the chat and we will email a link for you. If you're watching a recording of this, then simply email mike@flair.co.uk and just say ebook or recording or something, and I will send you the link, and that's it. So there's nothing else that goes with it. Now, I don't know what you think, Carl, but I reckon they're worth a bit of a watch. What do you reckon?
Without doubt, Mike. And of course, what you've talked about there is how you create scalable traits, which allows you to take a well-run, small business and create a large scaled business, which naturally, based on the things Sam said earlier, will have a huge bearing on attractiveness and value. So for sure, guys, if I was you, please do type 3 now in the chat box, because you definitely want to be able to access the free ebook without doubt. Kirsty, at this point, can I ask if we have any burning questions coming through in the chat that we'd like to answer or put to the panelists?
We do have some really good questions. Again, I'm going to do the kind of quick fire ones, hopefully. So one person has asked, how important are industry awards in increasing the ultimate EBITDA multiple achieved? So Sam, are you the best one for that?
Yeah, that's an interesting question. It's always something that we'll, of course, mention and allude to as part of the sale process, should they exist. You know, you always refer to the business as award-winning and things like that. I suppose I would probably argue that the business behind the awards is more important than the awards themselves. And if we're able to demonstrate to a buyer how good our business is, you know, they'll be more interested in that than the awards that we've won. But for sure, it's absolutely no bad thing.
Okay, fantastic. Thank you. Mike, here's a question for you that I think you're going to have an interesting point of view on. Somebody asked, what if you want or agree to sell, but you never really want to actually leave the business? And as somebody who this sort of happened to, I know you have a unique point of view on it.
Okay, yeah. I could spend the rest of our session just talking about this, but I won't. I'll do it in 3 sentences, right? That was me. I didn't want to retire. My other partner wanted to go, and he went pretty much soon after the sale. They locked me in for 3 years, and I was very happy for about 3.5 weeks. No, a bit longer than that, about 6-7 months. And then there started to be, they were very honourable, the people that bought us. I don't have a problem with it, but they had a change of management. Things changed for them. Priorities changed. The bottom dropped out of the IT market, big style. This is 2000. And they held me personally responsible for that. Like, what can I do about it, right? And we started to go in different directions. So my view is, yeah, go into it with that basis that you can stay for sure. But be prepared that you might need to make an exit because you don't know what's going to happen after the sale.
Thank you. And I think we've got one more time for question. Somebody's asked about the value of candidate data as IP and therefore increasing their valuation. Who would be the best person to take this question on?
Probably Sam. Sam, are you good to pick that up?
Yeah, it's interesting because I suppose given the kind of recruitment businesses are so human focused, as we all know, when we start thinking about valuing a business based on its assets and like things like candidate data, as I kind of touched on earlier, that's not really how recruitment businesses are valued on an asset basis. They're much more so valued on our recruiters. But if that wealth of candidate data in reality means the strength of relationships that are held within the business with those candidates by all of our consultants, that is for sure something that goes to value. So whilst if we're looking to sell the business as a whole, buyers won't necessarily be asking for a download of our CRM, you know, hopefully behind that CRM is a set of really strong long-standing relationships with our consultants and with the businesses as a whole to kind of demonstrate the value in that data? I don't know if there's anything you'd add to that, Carl. It's an interesting question.
Yeah, thanks, Sam. Just two things to add. I think, first of all, if your business is placing very, very skill short talent, i.e. you are a candidate-led business, then actually, of course, the value of the relationships you have with your candidates are invaluable. And whilst they might not therefore directly feature in the way in which your business is valued, the multiple will go up if you do have a very broad bank of candidates that you can draw down from, and those candidates are all active. I think the only other thing I'd say is if you are, say, a recruitment business and you are being acquired by a training provider, the training provider will be really focused on your candidate base because they'll be looking to cross-sell, i.e. can we use that candidate base to actually provide training services to that market. So I do think that that is important, certainly more so in candidate and skill short markets.
Fantastic. So as I said, we do have more questions that I don't have time to ask right now, but we will answer them at the end. So keep them coming.
Thanks, Kirsty. I just reflected on the question that was asked in relation to awards. And I just wanted to add one point, because actually, whilst having awards might not directly go to value, of course, being best in class and having awards will make your business more visible and as a consequence, more attractive. Because overseas acquirers, say, looking to buy a UK technology staffing business would probably look at the Recruiter Fast 50 and look to see which businesses have grown within the technology sector and which business has won awards, because that certainly is an initial indication as to success. So for sure, having awards will make you more attractive. It will put your business on the radar of potential acquirers. Will it go to value? Well, if you have a competitive process and you have many bidders, likely it will, but not mathematically. But the strategic value definitely will only go one way as a consequence.
I know we're short of time, literally 2 seconds. We were in the Independent 100 back in the day, fastest growing, and we were the 27th fastest growing UK private company. And then the following year, I think we were the 37th or something, whatever. And that did have an effect, definitely, in the way that Carl just suggested. So, yes.
Fantastic. I think
thanks, Mike. Appreciate that. So Ian, obviously at the beginning you said that one of the things you were going to kindly cover off was the importance of appointing the right advisors. And of course, whilst we on this call are slightly biased, given we are all advisors, it would be fascinating if you could just provide an insight into what advisors need to be appointed and when it comes to the potential sale of a recruitment business.
Sure. So look, the cynical amongst you may smell a whiff of self-promotion with this section, and that is your prerogative. But the message is quite simply this: get the best advisors and you'll get the best price. This is not the time to use your trusted old lawyers and accountants who you knew at university, bought your house, did your will, and have become your family friend and give you a good price. This is the chance to make a life-changing amount of money. So it's the time to use specialist professionals who sell recruitment businesses for a living. Now, they or we may be more expensive, but any increased costs, and I know, again, you will say I would say this, will pay for themselves many times over. Let me give you a good example of what happened in one case. So in 2022, we acted for the seller of an IT recruiter, and the sale involved completion accounts, so the amount that the seller got was adjusted according to what the company's account said at completion. And we recommended to the seller, as we always do when accounts are involved, that he used a proper firm of accountants. But he wanted to cut costs, and he chose to use his sole practitioner auditor, who just wasn't familiar with these sorts of deals. The buyer was a PLC, the parties fell out, and the buyer used PwC to claim over £1 million in adjustments. The matter became litigious, and the client had to engage our litigation team and specialist forensic accountants. Now, we eventually rebuffed the buyer, but it cost our client over £250,000 in additional professional fees to sort out the mess, which, again, cynic may say was good news for us, but it wasn't good news for the client. And we had recommended to him that as soon as we saw completion accounts, he used proper accountants. So what advisors do you need when it comes to selling your recruitment business? You need great corporate finance advisors like the guys that are with me on this panel. And of course, I would say great corporate lawyers. You'll also need tax advice, which can be provided by a firm like Sam's or lawyers like ours. And you may need some accountancy advice, depending on, I would say, how good your FD is and how complicated the structure is of the deal, whether it involves things like earnouts, completion accounts. Mike, what was your experience with advisors? Do you think it, be honest, I mean, do you think it made a difference to what you made?
Massive difference. I'll give you two quick examples, one with Mark Aspley and one with Carl. First of all, when we were looking to sell, we got a figure in our minds that we thought would be a top figure. KPMG, who did that first sale, got twice as much. We would have happily taken the check for the first amount, right? They did it in the way that Carl said. They played one buyer off against another and did a really good job around that. In the second negotiation, I can't remember what it was, Carl, but there was one thing that you did that saved us £600,000 on the price. Well, I would not have done that. It was a technical thing, a negotiation about allowances or something. I don't know, whatever it was. Really,
Mike, it actually related, and it's an important point. It related to the tax relief that arises in a company when EMI share options are exercised. That can often create a 6 or 7 figure cash-like item, which should be for the seller's account. But with respect, 99% of CF advisors wouldn't raise it.
Well, I hadn't got a clue, so whatever you did. Anyway, I was really grateful for the 600.
I'm sure you were, Mike. Albeit I'm disappointed you can't remember the technical nuance.
I wasn't really interested. But before I just hand back to Ian, in answer to the question, I'm not a corporate. I'm not one of these guys. It makes no difference to me whether you use them or not, really. But you'd be mad not to, like insane not to.
So thanks for that, Mike. So I'm nearly out of time, so no such thing as a free lunch, so please excuse me for 15 seconds of blatant self-promotion. There are two official guides to law firms called Legal 500 and Chambers, and both rank my firm Fladgate in the top tier for sales of up to 50 million. So if you do want a free follow-up call, please just type call, C-A-L-L, into the chat and I will connect with you afterwards. Thanks. Carl, back to you.
Thanks, Ian. And I think at this point, actually, what we agreed we would do is perhaps, Mike, just pass over to you. So you could maybe just give all of the guests on today's webinar an insight into how essential it is that one builds a strong, experienced management team in anticipation of a sale.
Yeah, now this is something I think you certainly mentioned before, and I've got a feeling that either Sam or Ian did earlier. But this is important, again, whether you sell your business or whether you don't. It doesn't make any difference. If you're growing a cash cow lifestyle business, which you're not going to sell probably, but you want to have a great time, make a load of money, you need a really good, strong management team. Now, you heard earlier that in the due diligence phase of my sale, and both of them, I think, I wasn't quite as close to the Crimson one, which Carl handled, which is why I don't talk about it quite as much. But in the first one, the buyers were very keen on the management team, and they wanted to know that there was a strong management team underneath me. So if I flipped out with the money, or took an early bath or something under a bus, then they would be okay. And as it turned out, when I left, the management team took over, and it was absolutely fine. So they were right to do that. But whether you're running the business to sell or not, probably everybody on that senior management team is going to be a fee earner or responsible for a team of fee earners. So if they go, or if they start to underperform, it's going to affect your profitability. And if you're just keeping the business, that's not good. And if you want to sell the business, that's not good. So I'm going to talk about something that we had. It wasn't called this at the time, so no one would have called it this in the 90s, or in fact in the noughties. But we had a thing called privilege of performance for the senior management team. That means that provided they hit 4 different things, targets, if you will, or ticks in boxes, that was performance. If their performance was what it needed to be, then the privileges they got would follow. So the performance for this, right? You've got to hit your targets. Okay, everyone gets a bad month from time to time, fine. But on the whole, you hit your targets every month. Second thing is you've got to show me a forecast for the next 3 months, so I'm confident that you're going to continue hitting your targets. The third thing is when I go out to your clients and I ask them what they think about you, they love you. They are very happy with what you do for them. And lastly, when I do the same with your team, they love you too. right? They're motivated and happy. They're not going to leave and go anywhere else because of you and the way you manage them. If you tick all of those 4 boxes, then you get the privileges. And the privileges that we had, now don't forget this is in the 90s, we did away with holiday entitlement. So you could take what you like. These guys could take whatever they wanted. They could work where they wanted. They could do the hours they wanted. As long as they were ticking those 4 boxes, I didn't care, quite frankly. We elevated them to a decision-making process, so they were part of the strategy building and execution of that. We paid them very high wages and lower bonuses, which is what they really wanted. And those bonuses were team-related, which was great. We didn't really pay commission to those guys. And also we had, I think Carl mentioned this, and so did Sam, a employee share option scheme, which was massively important. Paid out £3 million in the end, and I was delighted to write those checks. And I did write those checks, actually, the physical checks, and I would do it all over again. The second, I think, Carl, was about £1 million, as I recall, went out to the staff. It held the team together. And here's my key message, if I can share that with you, because it's something that, again, sell or not, you should do this. And the first thing is build and lock in that stable management team, even if it's only 2 people, doesn't matter. And one of the little maxims that we have, it's a bit twee, isn't it, really, but hire for show, you know, on LinkedIn, somebody shaking hands with a new hire and all that stuff, great, but you keep for dough. And the longer you keep a team together, the more productive and profitable it becomes. Chop it and change it will affect your profitability and therefore your value. And my actions for that, very simple. Define your version of privilege of performance. What have they got to do to get the privileges? And that becomes something that you can offer to people as a perk, but also as a way of locking them in. And the best way to lock them in is, in fact, a share option scheme. Now, I know we're running out of time, but I'm sure Carl's got something to say about share option schemes.
Sure, I absolutely do, Mike. I mean, as you say, one way of incentivizing a collection of individuals to help you grow your business is by sharing with them the upside in the value that they will create through an EMI share option scheme. But there are other ways, because not everyone will be incentivized by a share option scheme. And of course, a share option scheme is only relevant if at some point you are going to sell the business, because that is when the option will be exercised and become shares. So another thing you could do is simply put in place a profit share arrangement whereby your management team are able to access a percentage of the pre-tax profits of the business in the form of an annual bonus. But maybe that bonus is only paid out 9 months after the year end, which is a good way of incentivizing them and also tying them in. Of course, as you elevate your management team into senior positions, that's the time you should be looking to renegotiate your employment contract with them. So for greater reward, they should give greater commitment. So do they have a longer notice period? Are the non-compete and restrictive covenants that you are going to ask them to respect going to be more onerous? These are all ways of creating more glue with the key people, which will ultimately mean buyers will be less anxious about them as flight risk. A lot more we could cover off, but I think at this point, Kirsty, I'm just going to ask whether we've got any questions, please, in the chat box that would like to answer.
We do indeed. We have a really great one that a couple of people asked, so I am going to ask it first. And this one's for you, Ian. People are very much asking how advisors are paid. Are they based on a percentage of the ultimate transaction that they get? Are they paid by the hour? Are they paid on a lump sum? How are they often paid, Ian?
Yeah, it's different actually, depending which advisors. So, well, I'll actually, I think it's only fair for Carl and Sam to explain how they get paid, but the basis of legal fees is time. We sell our time and our brains. Typically, it will be around 1% of the total consideration you can expect to spend on good legal advice. Can get it cheaper. We're not the cheapest, but that is around what you should expect to spend.
Okay, thank you. And Carl, do you want to just very, very briefly explain how you guys would be paid?
Sure, indeed, Kirsty. So as corporate finance advisors, typically we would be engaged to not only lead, advise on the transaction, but also to provide transactional tax advice to the selling shareholders. Typically, Kirsty, we would charge not only a success fee, which is typically between 1.5% and 4% of the sale proceeds, often on a ratchet basis, so that we are financially incentivized to maximize the value that is achieved on sale of the business. But there's also a commitment fee, which is our client committing to the sale process and contributing toward the significant costs we will incur, typically over a 6 to 9 month period, which is how long it will take to advise on the sale of a business from engagement to close. And that commitment fee, Kirsty, is typically in the order of between £25,000 and £40,000, again, depending on the size, scale, and nature of the business that we are advising. Outside of the fees that will be paid to a corporate finance advisor, an M&A lawyer, I think the only thing I'd like to add is actually the timing of engagement, because this is sometimes not understood. So ordinarily, myself and Sam, or a similar corporate finance advisory firm, will be engaged first, because we would be the firm that would help the shareholders understand what the value of their business is, who is likely to be the most motivated, well-positioned strategic buyer who will see maximum value in the business that is going to be sold. And it is we, of course, who therefore would prepare the business for sale, market the business for sale, receive offers, negotiate offers, and ultimately take one party into heads of term / exclusivity. And it's only really when we have final offers would a seller group need to appoint Ian and Fladgate. So I just wanted to make that really clear, because it's corporate finance advisors that come first. M&A lawyers often are really only formally engaged when there are final offers to be considered.
Okay. All right, thank you very much. We do have a couple of more questions. If you do have any more, keep them coming. Sam, this one's for you. We've had quite a few people asking questions about the effect of remoteness. So whether that be that they're a remote business and they have no physical premises, does that affect the price? Or the fact that a substantial amount of their employees, their workers, are remote workers in the market. Does that have an effect?
So I suppose beyond the obvious impact of the lack of rent on profit and therefore increasing profits, I think that has more of an impact on when we're thinking about who our potential buyer would be. So obviously, businesses are more and more transitioning to this part remote or fully remote kind of working style, and obviously we'd need a buyer interested and engaged that was open and interested in that sort of arrangement. So I don't think it's something that would affect the kind of, I suppose everything would affect it implicitly. It wouldn't have a direct observable impact on the deal figures, but for sure it'd be something that we would probably be discussing with our buyers at length to make sure it's something that they were completely bought into, because clearly you don't want to go through a transaction and tell the entire employees that they need to be in the office on Monday. So I think that's how it would play into it more when we're thinking about the buyers, and then you'd assume that if the buyer was engaged in that sort of working situation, that would feed into price in their own way, but I don't think it'd have a direct financial impact.
Okay, fantastic. I do have another question for you, Sam, and Mike, I'm sure that you will have an input into this as well. Somebody's asked, are there preferences? So is a permanent work more preferred than contract work or vice versa? Is there a preference for retained work over contingency? And is there a preference for lots of small fees or one potentially large fee? Does that make a difference?
Yeah, a few really interesting questions in there, and I'm sure we could talk for 2 hours on all of them. I'll try and keep it fairly brief, so Mike can add for sure. But is there a preference on permanent work or contract? This is kind of, to some degree, a function of the market that you work in, right? So some markets will lend themselves a lot better to temporary than permanent. I suppose temporary, again, depending on your working arrangements, gives us some good sight and prediction over future revenue and income, which is always something you can imagine that buyers love to see. If they know how much money the business is going to make next year and 60% of that is locked in, that can only be a positive thing. Is there a preference for retained work over contingency? Again, I'd probably point towards retained over contingency for the same reasons. Is there a preference on lots of small fees or one big fee is an interesting one. And this all comes back to dependency and risk. So buyers don't want to see a lot of large fees, a small number of large fees from a small number of clients, because if one of those clients falls away, like Mike touched on previously, that's a massive hit to our income. What they like to see is a really good spread of fees, both between clients and from consultants, because if for whatever reason one of those falls away, the business is protected and it's not a material impact on performance. I've probably gone on a bit more than I wanted to there, Mike. I don't know if there's anything you'd add.
A couple of things, really. First of all, we were contract, and we were contract in those days very much attuned to preferred supplier lists. And I know for a fact, because Larry Robinson, the buyer, one of the buyers, told me that's what really attracted them, that and the RPO, because it was longer term committed revenue into the future. We had signed up preferred supplier deals for as much as 3 years in some cases, and we had contracts that were 12 months, 18 months long sometimes. Okay, so I think that longevity into the future mattered a lot. When it came down to the style of business that we didn't do retain because we really didn't do permanent. But I really think that the more you can lock yourself into a client, whether it's RPO, we also had an agency, software house, so we did big chunks of work for people as well. Again, all locked us into the client, reduces the risk, as Sam just said, and therefore bumps up the attractiveness and I think the multiplier.
Okay, fantastic. Thank you. So hopefully I can fit 2 more questions in, guys. So if your answers can be succinct. A couple of people have been asking about MBOs. Is it similar to a classic sale, which you guys have previously been speaking about, or does it make lower valuations? Is it cheaper to do? So Carl, could you give us a very brief answer on MBOs and the difference between a buyout?
Sure, absolutely, Kirsty. And actually, Sam's next section, the final section today, is actually to consider what exit options are available, because on this call, we've talked about selling a business to a trade acquirer, but that is only one of 4 ways in which a seller can realize capital value on sale of shares. So we will talk about MBOs just in a moment. But in answer to the direct question, Kirsty, actually, the idea of an MBO shouldn't lead you to conclude that the business would be sold for a sum which is less than what could be achieved with a business sold to trade. That is not necessarily the case. The reason why people may think that is the case is because a trade buyer will often have strategic motivations and reasons to acquire a business and therefore might pay more than a management team might pay. But that's not always the case. What I would say is very, very important to always understand in an MBO situation is that typically in an MBO, because the management team will be buying the business, they will, of course, have to fund the payment of the consideration to the seller. And often a management team won't have millions of pounds of cash sat on deposit. And as a consequence, not only will they need to seek third-party funding, but there'll often be an inability to secure all of that funding on day one, which will often mean the vendor will have to support the management team in buying the business, which is why in a buyout, often a vendor will have loan notes and or deferred consideration for many years into the future, because often that deferred consideration and loan note consideration will only be capable of being redeemed or repaid once the debt that has come into the business has been fully repaid. Okay. The other thing that is definitely worth considering in an MBO situation is that whilst a business could be sold to management for the same price that could be achieved were the business sold to trade, and whilst the seller may have to be a little more patient over when they receive the consideration, because the seller's selling a business to a management team who run the business and know the business, actually the seller will be asked for fewer warranties because the buyer knows the business. And therefore, actually, whilst the seller may receive less cash, the seller will likely keep it because the risk of a warranty claim being bought is materially less than were the business sold to a trade acquirer. Okay. So there are some really specific nuances that need to be considered, but for sure, an MBO can be a really viable, attractive way of a shareholder extracting capital value and selling the business to a buyer that is known to us, which can be sometimes as attractive as selling to a buyer that is not known to us.
Okay, fantastic. Well, we do have some more questions, but like I said, I feel like now is a good time to move on to the next section. And as I mentioned, any questions that come in now, we will answer at the end. So keep them coming.
Superstar. Thank you, Kirsty. So I think, as I mentioned just a moment ago, Sam now will just give everyone a brief insight into actually some of the options available when it comes to realizing the value of your shares in your business, because selling your business outright to trade is clearly just one option. So I'll pass over to you, please, Sam.
Perfect. Thanks, Carl. Yeah, and I think that last question was a brilliant segue into what I'm going to briefly touch on here. So we talked, we spent a lot of time talking today about your businesses, about how they would be sold and what you can do and what your advisors can do as part of that process. But what about who or what you're actually going to sell the business to? And that's what I'm going to briefly touch on just now in terms of this exit options section. So I think, my key message, I suppose, would be that you need to know that who your buyer is can and will materially change many aspects of the transaction, both financial and non-financial. As Carl just noted, I'm going to talk about the kind of 4 main routes for selling your business as kind of general options, and then we'll think about some of the ways that each route might impact, the transaction itself, the financial and the non-financial aspects. So the first option that I'll talk about when we're looking at sell the business is to go through a management buyout transaction or an MBO that Carl's just been talking about, where we will sell the business to management, and that's typically given the management team's likely resources, sponsored by either a debt fund or by a private equity investor. The second and slightly different option is a management buy-in or an MBI, where there'll be an external management team that come in and, again, usually backed by a debt provider or by a private equity investor. They'll come in and kind of enter the business and then run it themselves. The fourth option is to sell the business to trade. And actually, there's a difference here between selling 100% of our business to trade or selling a partial stake, even if it is a majority stake. It sounds very similar, but there's actually some really interesting and quite fundamental differences in how that transaction would look. And then the fifth and final exit option would be this partial or full sale of the business to an employee ownership trust or an EOT. On EOTs, Carl, do you think it's fair to say we're starting to see a lot more of them recently?
We are absolutely, Sam, and we won't go into the detail as to why, but I think the key reason is when you sell your business, either in full or in part to an EOT, you actually pay a 0% capital gains tax rate. So you pay no CGT on the proceeds you receive. So naturally, as a consequence, we're seeing a large number of EOT transactions completed in the recruitment sector, but there are a number of nuances that you would want to consider first.
Thanks, Carl. Yeah, I mean, a 0% tax certainly sounds good to me, but EOTs certainly are not right for every business or every shareholder for kind of some of the reasons we're going to touch on today. So those are different exit options that I've just run through. And like I've said, each different party and how they would view the transaction will have a material impact on different aspects of that transaction. So if you just kind of start thinking about what that might look like. So value, who's going to place, I think there's a question similar to this in the chat, who's going to place the most value on our business when we look to sell it? Now, it's a fairly big question, and one that, if viewed the wrong way, could probably cloud our thinking in terms of who we want to sell it to. The common thinking probably would be that trade would value it the highest, given the synergies they would enjoy once they bought the business. But as Carl said, that's definitely not necessarily the case. And actually, the headline valuation on the business is one thing, but it's only one piece of the puzzle when we think about the transaction. Another critical aspect is the structure. So if value is how much money we're getting, the deal structure is when we get it. So, it's all very well and good having the highest price put on the business, but if we're getting that over a period of 8 years, suddenly that's not so attractive. So when we're thinking about structure, it's definitely fair to assume that the buyers with maybe lower resources, so here we're thinking about an EOT or an MBO, you can probably definitely assume that they're going to give us our consideration over a prolonged period of time. So again, every deal is different, but whereas a trade buyer might, if there even is any deferred consideration, they might give us, that might be provided over kind of 1 or 2 years. You can definitely assume for an EOT, because of the reduced resources of that trust, you'll be getting your consideration there over the period of 5 years, if not more. Another kind of key aspect that will change how our buyers view structure is your ongoing involvement in the business and ultimately your buyer's appetite for that. So, a trade acquirer may well want to, fully integrate the business, and maybe you as head of the business, maybe there isn't a role for you on the other side of that transaction. Whereas maybe the MBO, if your business goes to an MBO, the management team might be really keen for you to stay on in some sort of consultancy role, these are all things that different parties will have different views on, for sure. And there are also things, like I said, that will go to structure. You can imagine if a trade buyer doesn't require you after a transaction, it's much less logical that there's any deferred consideration, because you can't necessarily impact the performance of the business, and therefore you shouldn't be affected, arguably, if performance dips. Another thing Carl briefly touched on, which is probably much more Ian's field than ours, but the legals and the warranties and how comprehensive they are, and how that affects actually how much cash you're able to hold on to after the fact. Another thing is the scope of diligence that someone might want to carry out. The diligence from a trade buyer is going to be a lot more comprehensive probably than the diligence sought by an MBO team, given they're in the business already. So there's so many different aspects, but I suppose the key message is, the deal will look materially different depending on who you're selling it to. There's many different options open to us, and they aren't all mutually exclusive. So, we can for sure explore a sale to trade and a sale to potentially a PE-funded MBO reasonably alongside one another. Some of them are more likely to be our sole focus. So, if we're going to pursue an EOT, that's probably a kind of a different offering to a trade sale or a PE-funded MBO. But it's really important to understand the nuances, because then you can make an informed decision about what's important to you when we're considering who the potential buyers are for your business. Carl, I think I'll pass back to you after that.
Indeed. Thank you, Sam. And I think just to summarize on what you've said there, clearly there are many ways in which you can realize value for your shares in your business. And what's really important, therefore, is when you are starting to think about your potential exit options, a feasibility needs to be undertaken. Because when you are establishing which of the aforementioned transactional types are most appropriate, we need to consider all component parts, whether that be valuation, the deal structure, and the impact that has from a tax perspective. We need to think about legacy. If you sell to trade, is there a chance that the business could be consumed, integrated, and rebranded, which is probably less likely were you to sell to management? Of course, what level of involvement would you as a seller have were you to sell your business to management versus trade? Lots of different things to consider, but having advised on hundreds and hundreds of these transactions, there's nothing we haven't seen many times before. And therefore, we always very much enjoy having some very early stage discussions to help establish what is actually achievable and feasible. Well, I think today our time is running short, and for sure, I'm sure everyone would like to join me in thanking my panelists for what has been a very thorough, very fluid, very interactive discussion, and of course, many questions which have been forwarded in have been answered. But let me just ask, Kirsty, are there any final burning questions that we do want to answer today, please?
We do have a couple, and I know if anybody has to go, and we are going to stay late and make sure they're all answered. There's one I definitely want to get in now, which is what percentage of the purchase price is paid by the buyer to the owner on a deal closer versus after or during an earnout? And what if you leave during an earnout or the market turns or something like that? So Sam, I guess that's a good question for you. And I know, Mike, you experienced it.
Thanks, Kirsty. Yeah, that very much feeds on of what I've just been talking about, and the answer is probably it depends who our buyer is, right? So a trade buyer is probably going to be more keen and more able to give us a higher percentage of our consideration on day one. A very, very broad brush assumption there is probably 60-ish% on day one, and then maybe 40% subject to deferred consideration or an earn-out. Whether it's deferred or an earn-out depends on the confidence that they have in our projections and our forecasts, which again feeds into whether we're doing temp or perm recruiting and all these different things. So yeah, it depends on who our buyer is fundamentally.
Okay, fantastic.
But I think, Kirsty, just to add, sorry, so I agree, Sam. I think typically when selling 100% of a business to trade, I'd expect to see 60 to 70% of the value paid in cash on close. The residual 30 to 40% would typically be paid on an earn-out basis over 12 to 24 months. And that earn-out will be contingent on the future profitability of the business that has been sold, Kirsty. Were a seller to leave the business during the earn-out period, that should not in any way mean the seller sacrifices the earn-out, because the earn-out won't be conditional on employment. In fact, we wouldn't allow it to be, because that might mean we run the risk of the earn-out being considered income rather than capital, and therefore subject to income tax. But naturally, if there is someone who is very involved in the running of the business and they leave, you might assume that would negatively impact the performance of the business and in turn might mean the earnout is not earned.
Okay, fantastic. Just a couple, I'm trying to get them in under time. So in your experience, is there a minimum EBITDA that should be achieved before a business is reaching a worthy multiple and buyout? And is this EBITDA on the current year only or grouped into the last couple of years? Sam, you're probably the best person for that.
Yeah, so I suppose a minimum EBITDA, it depends on what your ambitions are, right? It depends on how much money you want to make from the transaction and ultimately, what is an acceptable number to use. So I think I'd struggle to give a number on that. I think RGCF, we typically will look at transactions with a value between 5 and 75 million. So you're probably approaching, there are of course exceptions to that, but you're probably looking at approaching EBITDA of kind of 1 million or so to get to those transaction numbers.
I think that's right, Sam. And I think all I'd say, Kirsty, is that, if the view is that the right way to realize value is to see a business sold to a trade acquirer, then for sure, I think a trade acquirer would be certainly more excited were a business able to demonstrate that it has achieved or is forecasting to achieve an EBITDA of at least 500,000. But of course, if a business is being sold to a management team, then actually a 200,000-300,000 EBITDA business still can create significant value for the seller. And of course, if it's being acquired by management, then actually that sort of size criteria becomes less relevant. So every business can be bought and sold, but it depends on who the ultimate acquirer is as to whether scale is important or not.
Okay, fantastic. And I've just got 3 questions left, so hopefully we can push through them. So regarding BADR, somebody's spouse has a small percentage of the company, currently 5%. Do they get a portion of the release? Would it be better to give this person's wife 50% of the business so they get more?
Sure, I'll pick that up, Kirsty. Good question. So as long as you've held more than 5% of the shares in a trading business for more than 24 months prior to the sale of shares, then you are entitled to £1 million of business asset disposal relief. And therefore you pay 10% tax on the first £1 million of proceeds you receive. So naturally, what you want to make sure is that that spouse has a shareholding which will be at least equal to circa £1 million of proceeds. So they are enjoying 100% of their business asset disposal relief, Kirsty. So clearly, if you have a business that is likely to be worth £2 million on sale, then actually what you want to do is to make sure that husband and wife each own 50% of the business, because both will pay CGT at 10%.
Okay, fantastic. Thank you. The next question is, are most recruitment deals still adjusted for a cash surplus / debt free?
Yeah, so we didn't touch on it earlier, but all deals that we see will be on what's called a cash-free, debt-free basis, like you say there, Kirsty. So at the point of transaction, and this ties into the completion accounts that Ian mentioned earlier, we'll look at the balance sheet of the business because we've looked at the profit, right? And we've times that profit by multiple. But what about all the assets and liabilities on the balance sheet? Well, what happens is we'll look at them, and this, just to make really clear up front, this is still a negotiation exercise. It's certainly not straightforward. Anything that's deemed cash-like by us will be added to price. So if there's £1 million worth of cash in the business, you can think of that as being extracted by the seller at the point of the deal, and the price goes up by £1 million. Similarly, if anything that's deemed debt-like, so liabilities, and a really interesting one for recruitment businesses, especially temp-focused ones, is invoice discounting facilities and things like that. They, depending on the negotiations, they can be debt-like, they can be working capital. So the cash-like items get added, the debt-like items get taken away from price, and then I was getting ahead of myself there, but we'll also have what's called a normalized working capital adjustment, where we'll look at the trading history of the business and make an assessment on what the average working capital is of the business, right? So what the typical debtors are, what the typical creditors are, and there'll be a little adjustment in there for those. Without going deep into the detail, I just, that's a real point of negotiation, and there's some really, really interesting things in there. It's really important that your advisors are really, really clear on the detail in all of those, so that you're negotiating from a point of knowledge, basically. But yes, cash-free, debt-free.
Fantastic. And then the final question.
I know we'll run out of time, but I will just say, Sam, because we've not gave that section enough time there, because actually I know from my significant amount of experience, millions of pounds can be gained or lost in the adjustment negotiation involving cash, debt, and working capital. And to your point, Sam, around ID, most buyers would see ID as debt-like. And in a large temp business, that can take millions of pounds off the price. When I sold Mike's business, Crimson, to Harvey Nash did not treat ID as debt-like. Big win. The only other final thing I would just want to definitely leave there is there's a real tax point here, which is if you've got £500,000 in cash, leave it on balance sheet. Don't dividend it out, because if you dividend it out, you're going to pay income tax. Leave it on your balance sheet, sell your cash, and you'll pay CGT on that at either 10 or 20%. So again, a real great way to ultimately deliver more cash into your back pocket. Sorry, Kirsty, back to you for one final question.
One final question, which is somebody asked, is there any resources available to see case studies of previous business sales with details of multiples, for example, to see some industry examples for somebody to get an idea of what to expect?
Yeah, good question. And what we can do there, Kirsty, is we can share with anyone who's been on the webinar today a summary of transactions that have been executed year to date. And some will disclose the multiples that were paid for those businesses if, say, the acquirer was listed. Absolutely, that data we have and can share at any point.
Okay, fantastic. That's all of the questions done. We're very, very good.
Brilliant, Kirsty. Well, thank you so much for being a brilliant chat master today. And can I just again thank all of our panelists today for their very comprehensive, very thorough and very interesting insight. So Mike, Sam, Ian, thank you. And can I also thank everyone who's joined us for what's been a brilliant webinar. Naturally, we will be sending a link to this webinar to each of you via email by the close of business this Friday. If anyone has any questions for myself or Sam, or indeed Ian or Mike, please do get in touch. But for now, thank you, and we wish you a very successful Wednesday afternoon.